Hello, I'm Paul from Bezla. Arranging a capital stack for a hotel can seem like assembling a puzzle with moving parts, so today I'm going to look at filling the gap in your capital stack. Despite the availability of low-cost senior debt, many projects still seem to suffer a gap. Many are new constructions, but acquisitions can encounter the problem too. Owners are often looking for passive equity for their projects, hoping for lenders who will take a non-controlling interest and settle for lower returns. They want to see investors enter during the riskiest phases and to exit them from the deal at or before stabilization. Such investors are few and far between. Owners and developers would be better advised to seek a structure that appeals to a wider range of capital sources. Options available vary with a project's circumstances, but generally, good quality assets in strong markets with experienced sponsors have a much higher chance of attracting capital. The following options are effective and can normally be negotiated within a reasonable time frame. Key money can be an excellent way of sourcing additional capital. This is usually structured as a loan that pays off over the agreement period, which can sometimes be negotiated down to a shorter term. There is generally no interest unless the loan defaults. Most companies don't want to be the first capital into a deal, so they schedule payment to occur once the property is substantially complete or open. Payment may be earmarked for specific costs like FF&E, working capital, or operating shortfalls. The downside is reduced flexibility in negotiating management or franchise terms like fee structure, contract term, termination agreements, and performance outs. Just remember, key money is by no means free. Subordinate debt, usually structured as mezzanine debt, can be an effective tool to increase leverage. It costs more than senior debt, but less than equity return, and is secured by assigning the borrower's ownership interest. Owners can often add mezzanine debt to a senior loan to provide an overall loan-to-value of up to 85%. This capital can range in cost up to the high teens, depending upon circumstances. It generally terminates with the senior loan and may be interest only at a lower rate to allow cash flow to cover payments. Mezzanine lenders pay careful attention to a viable exit plan for their position, together with their basis in the asset in case of default. Cost will be adjusted to reflect the perceived risk. Negatives are the increased risk associated with higher leverage, difficulties in negotiating an inter-creditor agreement, and potential tax liability in the event of a default. For some projects, a third option is preferred equity. This may be structured as a direct ownership interest with a stated return that can include a kicker in the event of a sale or refinancing. Alternatively, the deal may include a cash waterfall feature, where the owner or developer has a promote position in its participation in the hotel's cash flow. Preferred equity may have a pay rate during the arrangement term, with a true-up rate upon a future capital event. For example, the preferred equity will capture the first cash flow produced until a base level of return is reached. Above that amount, cash flow would be split according to a prearranged scale or cash waterfall. Upon a sale or refinancing of the asset, the preferred equity would typically receive the first cash flow, taking it to a higher return of perhaps 20%. The cash waterfall formula negotiated would then dictate splits above the higher return. There can be multiple thresholds above the base level. There are several advantages to preferred equity: lower overall leverage, so better debt terms, no need for intercreditor agreement, no personal guarantees, and usually not being wiped out if project returns are below expectation, with cash flow not covering the preferred equity minimums. However, owners should be realistic about how capital will be structured and be prepared to share project returns. In conclusion, there are many options for filling a capital gap, but owners should understand the compromises that will be needed. Truly passive equity that is content with mediocre returns and narrow control provisions is rare. Owners should focus on a structure that benefits all parties. If Bezla could be of service to your hotel marketing, visit our website at bezla.com or give us a call at 888 999 8086. Thank you for watching.